Mr. Chairman, thank you. Michael Loftus, Wealth and Wisdom TV. Quick question, as we've now put $324 billion into the market for liquidity purposes since September, should the American investor be concerned?
Steve.
Remake!
One final question, sir. If the Fed stopped tomorrow putting money into the market, what would that do to the overall markets? Hello, this is Michael Loftus for Wealth and Wisdom TV. First up, don't forget, click Show More for additional information and links. I've got several articles down there today for today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. So, first up, today's agenda. We're going to go through our signals. We're going to do the big charts, treasuries, what keeps me up at night. We're going to follow up on that Fed opening, sector spotlight, and game plan going forward. Let's go to the big charts. First up, we're going to take a long-term view, very long-term. If you're new to the channel, here you go. So we have secular bear and secular bull markets, and you can see them. The red is obviously bear. What a lot of people forget is from 2000 to 2015, we went sideways, right? The market really went nowhere. That's why that is considered a secular bear market. And since then, we have gone straight up. Now, when I look at things from this long-term view, this is actually pointing up as well, which is momentum. So in theory, this could continue going up. But let's take a look at the closer view here. Going to move quick here. Short term, positive signal. Obviously, despite what I see on the fundamental side, we'll get into that. When you look at what's going on, volatility below 15, market likes that. That's a good time to buy. Momentum's pointing up. We continue to go to the upside. Now, we haven't shown this because it's been a couple weeks. Here's your weekly chart, right? We had this little pattern there. We broke out. Again, very bullish. Midterm is also positive. Now, here we have the monthly chart, which is obviously the longer term view. And there's a couple things that I'll point out. On the positive side, we did have a positive momentum shift to the upside. Okay, that is a good bullish signal. The only thing that concerns me, we've talked about this is called negative divergence, right? This is relative strength. And as you see, you have a series of lower highs while the market continues to go up, but still obviously positive. So right now, I look underneath the hood, this shows new highs minus new lows, pretty much the same throughout, meaning we're kind of stuck in this range until yesterday. Look at that. That thing took off. One day does not make a market. So let's see what happens here. But again, overall, this has been pretty flat with new highs minus new lows. So again, all signs right now show a bullish take. How about treasuries? What's going on here? Not surprising where we are in the cycle right now. We're trading in a range, but we are trading down on the Treasury yields. Now, the biggest thing here that stands out recently is after the Fed move, this is what they look for. Your 2-year and your Fed rate are very much in line. That's what they've been trying to achieve. The next big thing here is recession fears. I've been talking about this in the past. If we invert, go down to 0, we got close, okay, on the 10-2 year. But right now, we don't see a recession on the radar, maybe 2021. But based on where we are today, I just don't see it. Next up, what keeps me up at night? Before I talk about what keeps me up at night, due to compliance, we've had to turn off comments. So join us on Facebook and Twitter, and I can answer any questions you have there. So underneath the macro, the fundamental data continues to look ugly. I could give you a series of charts, but let's start right here. Manufacturing, okay? What's the key to manufacturing? When you go below 50, that's considered contracting. So we've been there for a couple months. More of an indicator, here's ISM orders, right? That makes sense. So again, we continue to look pretty ugly there. CPI, this is critical right now. Why? Because part of our portfolio, based on where we are in the cycle, is on this theory of rising inflation, okay? CPI, Consumer Price Index. Prices are going up. Now you hear the Fed saying they have their 2% target, which they haven't hit for 10 years, but please tell me, who doesn't feel we're paying more for groceries, clothing, etc.? It's kind of a little bit funny, okay? Next up, look at this. Initial claims. Huge jump this past week, okay, in initial claims. We haven't had a hit like that, okay, and that was after a major storm. So is it a blip or is it something more we need to watch? We are seeing some big companies, one of the big financial companies announced some layoffs as well. So in the opening, had a little fun with the Fed, but this is not a laughing matter, okay? You've heard the term, don't fight the Fed. What does that mean? When the Fed is accommodative and they're putting liquidity into the market, you want to be in the market, right? And that's what happens, and I'll show you an example of that. So here's long term, going back to 2002, and we had a slight rise after our dot-com crash, and then of course it spiked big time. This is quantitative easing, where they flooded the market with liquidity, and they're buying treasuries, it could be tips, mortgage backs. They're basically giving the market a lot of liquidity, so hopefully the banks will take that money and loan. That's the whole concept, and give them comfort. Now we see what happened, okay, this thing continued on, then they stopped, and then right here they started quantitative tightening, where they stopped the program and they started to let things come off their balance sheet, and they went down, which is a good thing. Now, you see this blip here at the end. This is what's happened recently, and we'll get more on that in the next slide. But when I say don't fight the Fed, when I take a look at the next chart, I'm going to overlay the S&P. You might have to pause it with the colors. I did my best here. But you can see the impact. So the Fed started getting involved back here in the 2000s, and the market goes up, okay? And then here's QE, Operation Twist. QE, right? And then QT started here. So look at the market goes up as the Fed drives liquidity into the market, and you can see it here at the end as well. And then, of course, we really had that pause when they paused and start going down, and that's what happens to the market, okay? So let's look at what's happened very recently, okay? So back in September, the market dried up. There was no liquidity, all right? This should not happen. Combination of earnings going down, hedge funds having too much leverage, etc. Now keep in mind, the Fed's mandate is monetary policy. This is not about monetary policy. So in the past, this past week, Paul Volcker passed away. He's kind of the godfather of the Fed. He took us from 18% to 3%, and it was painful, right? That's what should happen. Then you had, I'll say, Greenspan, Bernanke, Yellen, all of the same ilk, where problems came about and then they flooded the market. What Powell is trying to do is avoid the downturn by flooding the market now. So back here, when the market dried up back in September 20th, they said they're going to start a little bit of a program. Well, guess what, folks? A little bit of a program as of Wednesday has now become $324 billion they have flooded with the market. They're not calling it QE. Let me tell you, that's quantitative easing. Now, The impact short term has been massive, right? We've been in a flat market cycle for quite some time. Here you can see as quantitative tightening started. Okay, again, I've got the S&P behind in dark blue, light blue is the Fed. So here, the market, you can see it, right? They stop and the market's been doing nothing. Guess what? They start flooding the market, and look at what happens to the market going forward. That's why they say don't fight the Fed. That's why we're fully invested right now, not just in large cap growth and other cycles. But here's the thing. They've already announced by the end of the year, okay, they're going to be dumping another $500 billion into the market because you generally will have some type of liquidity issues going into the end of the year. That's going to put us back above our all-time high. This is a big problem. Now, I joked about in the beginning what would happen if they stopped. I'm telling you, this is an issue. If they can somehow create a soft landing, good on them. Not sure yet, very much to be determined. So, with that, what's going on? Let's talk about my sector spotlight and game plan going forward. So as we head into this month, we talked about don't fight the Fed, but the market is such greater. What if the Fed pulls liquidity from the market? You don't want to be 100% in large cap growth or NASDAQ technology, etc. So that's why we talk about diversification. Now, we're not your typical diversifiers. We're in a lot of different sectors right now. So our largest position is large cap growth right now. And what we started to shift into this quarter were sectors that were specific to rising inflation. Okay, so how do you see that? Here's your CRB index. Compromises 19 different sectors. You can look that up. There's a lot of areas that you can go into, and it's pretty easy to see, right? You kind of bottomed here. That's a higher low, right? And then we keep going up. So from a bullish standpoint, that looks very bullish on inflation. Make sense? So how do you capitalize on some of the inflation-based areas? So the first one, our biggest position right now, is oil-related. And there's a lot of different ways, and I'll talk about that in a second. So when you look at oil, the first thing is this is what I'll call reverse head and shoulders. Left shoulder, right shoulder, and there's your head. A very bullish setup, and as you see here, right, slowly grinding higher. So when you look at oil in the last week, as well as the S&P has done, oil has really done much better. So a couple other things here when you look at oil that I look for. Volatility, okay? Critical. When we're below 30, we're at 26 right now. That is a good time to buy oil. And you can kind of look at it. When you spike, right, is when things get pretty bad and they go down. So not a lot of volatility in the area. And then what do we look for and how do you buy this? Obviously, big oil companies, and there's ETFs, funds, individuals, however you choose to do it. We use ETFs here. So you can buy the big oil companies, or there's a lot of things that are correlated to the price of oil, which is also what we have, and therefore S&P largest position, large cap growth. Our second largest is right here in the oil sectors, okay? Now, some of the other things that I've stuck with since last November, again, based on the cycle, are bond proxies. Those are sectors that do well when rates are low. Look at this chart, home construction, okay? I mean, obviously, that is a bullish trend. So when you look at this, this is where you look for opportunity. This is called a consolidation, okay? But the most important thing is it's held the 50-day moving average. So if you've missed this, you look for opportunities. You can see the consolidation here to get in, okay? And that's some of these bond proxy sectors, as right now, several of them have taken a pause. Next up, healthcare. Something we talked about for a while. Didn't go anywhere. You can kind of see that, right, for quite some time. But patience, in this part of the cycle, healthcare does well. Okay, you can see that surge. Obviously getting a little bit expensive up here. That's relative strength. I wouldn't necessarily buy it right now because it is kind of overpriced. You wait for that pullback or consolidation. But in this part of the cycle, healthcare is one of those sectors that does very well. So bringing this all together for my game plan, as of today, game plan is you can't fight the Fed. So you've got to be invested. Don't have to be, but be in there and be cautious. That's exactly what I'm doing right now. I am invested. I'm looking at other sectors that do well in this part of the cycle, not just based on what the Fed is doing, pumping money in and driving this market up, because again, if they pull it out, that could be an issue. Wrapping things up, let's go to fear and greed. Fear and greed. First up, you can click below on how they get this calculation. 2 weeks ago, 84, extreme greed, still considered extreme greed. But despite all this, all of our signals are positive right now, short-term, mid-term, long-term. But I'm going to go back to stay nimble, folks. Not sure what's going to happen going into the end of the year. Let's see what happens. It's been a good year and see where it takes us next year. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.